What's up, everybody? It's Megan here with Student Loan Planner, and we're going to chat about how to save money on taxes as a dentist with student loans. And I bet you didn't know, or maybe you did, that dentists are the most indebted profession out there when it comes to student loans. The average balances that we're seeing with student loan debt for folks in dentistry, for a dentist, we're seeing about $415,000 of student loan debt outstanding. For orthodontists, we're seeing a lot more. We're seeing about $615,000 in student loan debt, which makes sense. There's a little more schooling there. So very indebted, right? Not a surprise. That's why you're probably here listening to try to figure out how to save money on taxes, which is the other thing, right? Student loans and taxes. So I've got some good news for you. There's lots of ways we could save some money. So let's dive right into kind of the lowest hanging fruit on what we could jump into that could be relevant to almost anybody. And I'm actually going to cheat and start with interest subsidies, which this is technically not taxes, but I want to challenge you to think about maybe your student loans as a tax on your income. So many of you know that with student loan debt, we can go towards loan forgiveness. There are forgiveness plans, income driven repayment plans that forgive the balance that's left over after 20 or 25 years of repayment. And so we treat, especially with our dentist folks, we treat student loan debt as a tax on your income if our balance is a lot greater than our income and the math makes sense for us to do the loan forgiveness instead of paying the loans off. So instead of thinking about it like a debt in that sense, if we're going towards that loan forgiveness timeline, then we want to be treating the loans like a tax. And what do we do with taxes? We try to reduce taxes as much as possible. So some interesting pieces to, or actually one of the income driven plans called Save, it has a really nice interest subsidy. And this is, I think, could be relevant. This is first on my list because this could be relevant to anybody, even if you're not going towards loan forgiveness, because almost everybody who's graduating from dental school, the year before graduation, you probably didn't make very much income. Right? You probably didn't make much income at all because you were busy finishing out school. So when you file your tax return for the year before graduation, it's probably going to be zero, like no income or very little income. And so with that being said, on an income driven plan with student loans, what they do is they link back to your most recently filed tax return to verify your income to get you onto that income driven plan. Well, if your last tax return was zero or really low income, that means your payment can legitimately be zero or very, very low. And the benefit to that, even if you're not going towards loan forgiveness, is the interest subsidies that are with income driven plans, mainly the Save plan. So, Save, what it does is it says, hey, if you have any unpaid interest each month, we're going to waive that. Don't even worry about it, right? So, that's pretty crazy because usually, if we had unpaid interest, like if our payment was not enough to cover the principal and the interest that month, then the unpaid interest would grow on the balance, which is obviously not good. If we're going towards forgiveness, it's less important. If we're trying to pay the loans off, that's a really scary thing, right? But first year after graduating, you're going to have some pretty low income. You're probably in residency or in the first year of your career. So income is going to be pretty low. You're probably trying to figure out your budget. So you can take advantage of that $0 payment or that really low payment and the interest subsidies that come along with it versus what we used to see a lot of is people going into forbearance, which is where they would just pause their payments, freeze everything so they didn't have to pay, but then interest accrues, right? It grows on the balance. So we might as well take advantage of one of the income driven plans, get the subsidy to pay our interest for us or to waive it. And if we're going towards forgiveness, great. That just means the balance at the time of forgiveness is going to be less. Maybe helps quell some mental anxiety about that. If we're going to pay the loans off, it's going to help reduce our interest cost a lot in that first couple, that first year or the first couple years, really. So I mentioned that one because that one's a superstar for really anybody trying to save money on taxes, which in this case, I'm considering your student loan a tax on your income. So next up, we've got HSAs, FSAs, 401ks. So how can we save money on taxes? Well, we can make our income look less. So our taxable income is less and our tax bracket is less. So how can we do that without like intentionally trying to make less money? We can contribute to pre-tax buckets. HSA is a health savings account. That's where you could put money to pay for things like, out of pocket expenses, prescriptions, things that we have to pay for that our health insurance doesn't cover. And some other stuff too, like chiropractic, things like that. FSA is similar. FSA is a use it or lose it bucket. That means what we put into it over the course of the year, we need to use by the end of the year, or else we lose the benefit, which is kind of stinky. It's not a huge amount that you can put in an FSA per year, but still, it is a great option if it's the only option you have. That's something to consider. Now, 401ks. 401ks, they are usually going to be offered by your employer. We're going to talk about contractors here in a minute and what to do if you don't have a 401k option. But 401ks is a way to save for retirement. It's pre-tax. You can contribute as of 2024, $23,000 to this bucket, which is a big bucket to throw money into that kind of hides it from your taxable income. The plus side to contributing to these things, they're great buckets for savings, for healthcare expenses. They're great buckets for retirement, which I know is probably far off than what you're thinking of right now, but still, great buckets for those things. But also, they have a positive correlated relationship with your student loans, because the lower your adjusted gross income is, the lower you're going to pay in taxes, but also the lower your student loan payment's going to be if you're on an income-driven plan. So that's a plus right there. Now, the third thing on here, it could be related to really anybody, is tax loss harvesting. What the heck is that? Well, that has to do with taxable brokerage savings accounts or investment accounts. So this is not your retirement accounts. It's not your 401k. It's not your Roth IRA. It's not your HSA. This is just an investment account that is not tied to retirement. And a brokerage account is a way that you can save and invest without having limitations on when you can access that money, which is pretty cool. But it is what it sounds, what I mentioned before, it's taxable. So that just means if we take money out, if the money we invested in there grew, we're going to have some capital gains taxes that we're probably going to have to pay. And that just means that if we put in 1,000, we let it sit and it grew over the next couple of years to 1,300, we have a $300 gain. And when we take that money out for whatever reason, that $300 gain is taxable to you. Now, if it's left in the account longer than 12 months, it's a long-term capital gain, which is better. We pay less in taxes versus like income tax on capital gains, long-term capital gains. But tax loss harvesting, what that is basically strategically selling positions that are not doing so hot within our portfolio. This is kind of a complicated, or I won't say complicated, but it is a more complex investing strategy. So look out, this may not be something that you would be doing personally, but maybe you'd be working with someone, an advisor, a certified financial planner, to be doing this for you. But tax loss harvesting can be a really great way to kind of hoard losses. So we strategically sell positions that are not doing great, and that means we could take a loss on that decrease in value. But what we do is we don't just take the money out, we sell that position and we purchase something very similar. Not the same fund, but we purchase something very similar. And the benefit to that is we get to take the loss, but we're still invested in the market. And so what does that do? That means we have a loss that we can write off against a gain, or it could go against a gain in that same year. If you take money out, but another position did really well, you can write that off against the gain, which saves you on taxes, right? So we're coming back to the taxes here. So this is a really cool strategy. It is more complex, but I think this is something worth entertaining, especially if you're wanting to be a practice owner in the future, because maybe you have a practice to sell in the future, which would have a huge capital gain, hopefully, right? And also for those who want to retire early. Your 401k plans you can't touch until 59 and a half. And if you want to retire early 50s, then that account is not something you're going to want to access because you're going to have some penalties with it. So a brokerage account could be something that you could open and use as an earlier retirement savings vehicle. So now we're getting into some like financial planning topics, but that is one also another way we could save on taxes. Now, next up is for contractors. So this may not be relevant to everybody, but if you are a contractor earning additional income, 1099 income, there are some things that you can do to be smart about how you're taxed on that income. If you elect to be taxed as an S Corp, a solo corporation, you can do that if you open an LLC for that 1099 income, or you can straight out open an S Corp tax election. And you can basically, there's that is a way to save on self-employment tax. So this is something that you might want to chat with a CPA about, a tax preparer about, or a financial advisor about. But it is a way to save on self-employment taxes strategically. Usually you want to be making more than about $100,000 a year for this to start to make sense. There's some technicalities there, but and then the other thing that you need to know about being a contractor, having an S corp, or having a LLC that elects to file as an S corp, is you can open a solo 401k. So you might be thinking, dang, I'm 1099. I don't have access to an employer account to contribute to for retirement. I don't have those nice like pre-tax buckets. Well, great news is you can open a solo 401k. And that is just what it sounds like. It is a solo account. You are the only person who's going to be contributing to it. And you can contribute up to the $23,000 employee maximum, which is the 2024 maximum right now. And you are also the employer. You're the employee and the employer if you have an S Corp or an LLC and you're filing as an S Corp. And that just means you have no employees. It's just you. So if you are both the employee and the employer, you can contribute to the solo 401k as the employee, the 23,000 max, and you can contribute the employer max, which can go up to 69,000. There are some limits there. It depends on how much your net income is going to be. There's some calculations you have to do to make sure you can contribute up to that maximum as an employer. But it's a really good bucket. It's a really big bucket to be setting money aside for retirement. And it of course reduces our adjusted gross income, which saves us money on taxes. So really quick, nice tip there. Now, practice owners. So if you are a practice owner or you're planning to be a practice owner, Secure 2.0 did some good for us. Okay. So practice owners have the opportunity or the option to give benefits to our practice, our employees. So the things we were talking about earlier, HSAs, FSAs, 401ks, those types of things, you as the practice owner can choose to provide those benefits to your employees, which I think could be a really great idea because one, it's a great benefit to your employees, keeps them around, gives them some benefits, and it's a great tax deduction for you as the business owner. Now, the Secure 2.0 Act created some really nice credits and things that make the cost of opening a 401k, which usually there's like an upfront cost with a company to get the plan established and maybe a monthly ongoing maintenance cost, which shouldn't be too bad. But the Secure 2.0 Act really helped give business owners credits, tax credits for opening these types of accounts for their employees. They really want you to be helping your employees save for retirement and invest in these vehicles. So there's some great tax breaks to business owners that do that. So you might be thinking, it sounds like a lot of work. It sounds like it's expensive to set up a 401k. On the contrary, it is not that hard anymore. It used to be, but there's lots of avenues you can go to open these now in a much more efficient manner and very cost effective too, especially with these tax credits. So those are some general ways that we could save money on taxes as a dentist, as a contractor, as a practice owner. Let's talk a little bit more about student loans specifically and how taxes can impact the student loans and vice versa, because that's a big piece to our financial puzzle here, right? So, student loan specific ways to save money. So, if you are a student loan borrower and you are married, let's say you're married, let's pretend your spouse does not have student loans. Well, if you're on an income driven plan going towards loan forgiveness, if you file taxes married jointly with your spouse, which most people do, your student loan payment is going to be based off of joint income. Ugh, right? Ew, what? How does that even make sense? I know, it is so silly. But that's how it is. So if we file taxes married jointly, your spouse's income, if they earn income, is going to be included into your student loan payment calculation. So if that is unfair or it's going to really make your payment a lot higher than you anticipated, good news is we can consider filing taxes married separately. So that's this section here. So married filing separately is a tax filing status that you can choose year to year. Every year, you can make the decision, do I want to file jointly or separately? Folks with student loans typically consider filing taxes separately because it can keep the payment off of just our own income. And that makes for a lower payment, and that helps us get towards loan forgiveness a lot more efficiently. And again, remember, student loan payments are a tax on your income. That's how we're going to be thinking about them if we're going towards loan forgiveness. So filing separately could really be something to consider here. So that is something to think about, to chat with a CPA about. Consultants like us, we can help run the differences between the two, what it would look like to file separately and what that does to the student loan payment, what filing jointly would look like, what that crossover point would need to be, because you might be thinking, oh, well, filing jointly is going to save me more on taxes. And you are correct. Filing jointly will save you more on taxes, usually, almost always. But what is the crossover point, right? Does filing separately save us enough on our student loan payments to warrant the cost of filing separately? I don't know. We have to run the numbers. So that is something to consider. Now, to the tune of this, amending tax returns could be something that you do. So, amending a return is allowable up to 3 years in the past. So, let's say, last year you filed taxes separately. We, updated our income for our student loan payment. It was off of that 2020. We're in 2024 right now, so 2023 tax return. It was a separate return, but we lost out on $3,000 of tax savings or $5,000 of tax savings, whatever it is, compared to filing jointly. That's stinky, right? So what we can do is we can go back and amend that separate return back from separate to joint. And what that does is it helps us recoup that lost tax savings. So that's something that we sometimes suggest, is if there is a pretty big tax hit to filing separately, but it still makes more sense to do that for our student loan plan, then we can kind of bite the bullet, take the hit, and then go back and amend that tax return later. So that's something to consider. And then the last thing I want to mention here that could be really advantageous, really something to consider if you have student loans that has to do with taxes, is if you live in a community property state. What is a community property state? They're mostly the states on the Pacific coast and Mexico border. So that's Washington state, that is California, Nevada, New Mexico, Louisiana, Texas, Idaho. I forgot Idaho up north, and then also Wisconsin. So Oregon is not a community property state, but Wisconsin is. So if you live in any of these states, this is something to pay attention to, because filing taxes separately in your state is a little different. Even though it's a federal tax return, your state dictates how the federal tax return has to divide the income between your returns. This is advantageous. This is a really good thing. If you live in one of these states and you're considering filing taxes separately, let's say your spouse earns less income than you, or let's say your spouse is a stay-at-home spouse. If we file taxes married separately, that state looks at all of your income for the year, and it basically what it does is it takes your household income and it divides it in half between the two tax returns, your tax return and your spouse's tax return, if we're filing separately. So instead of your income showing up on your return and your spouse's income showing up on theirs, your household average shows up on both returns. And this could be beneficial because let's say your spouse doesn't earn any income. Your income now looks like half of your own income because they take our total income together as a couple, divide it in half between the two tax returns, and that is what your tax return says. And the student loan payment is based off of that tax return. If we file separately, it goes off of that half of the household income. So pretty cool trick here, right? And so that's a really great thing. Now, the positive here too is it can't hurt you. So if you have the student loans, but your spouse earns more income than you, that income split will make your income look higher, but you can submit alternative documentation of income to keep the payment off of just your own income. So if it sounds like there's a lot of tricks here, there's a lot of cool tricks that we could do and we can pull out if it's applicable or if it makes sense for your student loan situation to try to get you to save the most money on both student loans and taxes. So check out a consultation if you're wanting some one-on-one help with us. We can do this analysis specifically on your case. Not every case is the same. Your dentist colleague probably has a different set of facts that goes into their student loan plan, and vice versa. Your plan is not going to look like their plan, probably might be similar, might have a similar flavor, but there's a lot of details that go into what makes somebody's student loan plan customized. And a lot of specifics go into how we save you the most money, and that has to do with your financial picture. So if you need some help, you want some one-on-one guidance on this stuff, let us know. Schedule a consultation with us. But hopefully this was helpful, and I'm going to see you in the next video. Thanks.